So at the top level, you can do something called an ESOP. An ESOP is an employee stock ownership plan where you sell between 33 and 49%. Mind you, this is a minority stake in your business, and a bank will finance your employees, backstopping that debt with the equity that you sell them. Employees get the equity here, bank is here, and then there's you. And so the bank gives you money and lends it to the employees to pay you using the stock that you gave them as collateral. Now, what's interesting about this, at least in the United States, and I'm sure there's different functions like this internationally, is that this payment, at least in our tax laws, is tax-free. And so you get a smaller multiple because banks will always pay less because they have to think about risk, not upside, than potentially a private equity buyer would. But this is tax-free to the owner, which is pretty sweet. Now, one of the other nice things here is that you still maintain control of your business because you still own majority. And so if you do it in this way, you can help your employees get wealthy, you get a tax-free check, they get to participate in the growth of the business, and oftentimes ESOPs can go well because then now you have a huge team of people who are also incentivizing growing the business and, quote, act like owners. But they didn't need to come up with the money. It's like, here's your stock, and then they go straight to the bank, and then the bank gives them the loan to pay you for the stock you gave them. It's kind of how it works, okay? That's version A of this. Now, the way this works, though, is that you just traded the equity and you get cash for what you gave the employees, but you still own the asset. And so the asset is still worth what it is in the private realm. So if you add those two things together, you still have $1 billion, but you get the liquidity and you keep the control. The version B of this is something called a dividend recap. So dividend recap is using the same bank structure that you'd have with an ESOP, except you just cut the employees out of it. You just go directly to the bank and say, hey, how much will you loan me using my entire business as collateral? Now, if you think, that's weird, think about it like buying a house. If you buy a house, you go to the bank, you put X% down, and they give you debt for the rest of it, and then you pay that debt off. And so the business actually works the same way. So if you have no debt on the business, or even if you do have debt on the business, you go and say, hey, we can reliably produce this much income. And so we could pay off this level of debt. And so then a bank would say, okay, well, we'll give you 4 times or 5 times your total EBITDA or your earnings for the year, roughly, and we'll give you that as debt. So if I make $100 million a year, they might give me a $500 million loan that they know that my business will be able to pay the interest off on, which for them makes sense because they're just getting paid to give money that they loaned out, right? And then you have terms associated with that debt, right? Now, if your business is growing, then it makes a ton of sense to do that. You de-risk a little bit as an owner, and the key point here is that the business carries the debt, not you personally. And so you as a person, the owner of the business, gets to take the $500 million, but the business pays the debt off. And so let's say 5 years later, maybe the business pays all of the debt off, you got the $500 million, and you still own the business, just like owning a house at the end of paying it off. Works the same way. Kind of cool. Now, the third version of this is one that people are a little bit more familiar with, which we kind of used earlier, which is public equities, meaning you go public with the company that you have. And so now, when you go public, you only have to sell a small percentage of shares in order to make them available to the public. And by doing that, the remainder of the stock that you have starts to have an actual marketplace value. And so the value of this, and this is one of the biggest benefits of going public, is that you don't have to sell 33 to 49% of your shares. You could sell 10%. Or 5% of your shares. And then the other 95% has a market value in real time. And so then you can still go to those same institutions, banks, et cetera, and say, hey, I want you to loan me. And the thing is here you can do it piecemeal. You don't have to go through a 6-month process or 12-month process to get one specific amount. You can say, hey, lend me $5 million today. Lend me $20 million a month.